Hey there. In this video, I want to talk about volatility, and in particular, implied volatility and why it's important in options trading, and most importantly, how we can use it to make money. So I've been trying to keep the amount of math limited in these videos, but there's a tiny bit of math in this video, just a couple of formulas, but it's nothing too outrageous. So let's jump into the slide presentation and get into it. So what exactly is volatility? In trading, when people talk about volatility, or I'll just say vol for short, when they speak about vol, they generally mean one of two things, either historic volatility or implied volatility. Historical volatility, as the name suggests, is a backward-looking metric. So it's calculated from historical stock returns, and then you derive a number from that. Implied volatility is a forward-looking calculation. It is the market's best guess of what volatility, what ranges of prices are going to occur in the future. And it's calculated directly from the option prices, option chain. So here is our tiny bit of math. So we need to understand what a standard deviation is. To get an idea of that, let's start with the simple mean or average. So basically in high school math, if you want to calculate the average of a series of numbers, so where's my cursor here? Why does it always jump around when I'm recording? So if we have a bunch of numbers, say x1, x2, x3, x4, to calculate the average, it's pretty simple. You just add all those numbers up. That's what this capital sigma here means, from 1 to n, and then we divide by our number of points. So this is trivial. If we take the numbers 7, 2, 5, and 12, we add them up. We get whatever. We divide by the total number of numbers, which is 4, and we get 6.5. Simple arithmetic mean, simple average. So what is a standard deviation then? So here's the formula for the standard deviation. If we ignore the square root, it kind of looks like the mean, the formula for the mean. So if mu is our mean, what we're looking at is basically taking each point, subtracting the mean off of it, squaring it, and then averaging that. So it's basically the sum of the squared deviations from the mean as an average, expressed as an average. So basically it just tells you how your data is scattered about the average. So with the example from the previous slide, if we have this sequence of numbers here, we said that the mean was 6.5. If we plug this into this formula up here and calculate the standard deviation, we get this number here. So about 3.64. So the scatter about the mean is going to be roughly 3.64. So this curve here is your standard normal distribution, or basically a bell curve that describes many things, like the distribution of heights in a population. The mean of this distribution here is 0. Obviously heights are not 0, but run with it for the sake of this. So the standard deviation is going to tell you what percentage of the population is going to fall within certain buckets. So here we have this plus or minus 1 standard deviation down here, and you notice that roughly 68%, a little more than 2/3, are going to fall within 1 standard deviation. If we go out to 2 standard deviations, that number reaches basically up to roughly 95%. So 95% are within 2 standard deviations. And if you go out to 3 standard deviations, it's almost 99%. So almost everybody is within 3 standard deviations of the mean. So historical volatility is just this applied to historical data. So you're calculating the standard deviation of returns. So in this plot here, I have calculated the data set I had on hand is, I think, from middle 2015 to middle 2020, just because that's what I had. And this is the ETF that tracks the S&P 500. So this is SPY. I've calculated the daily percent change in that stock and plotted it as a histogram here, and then calculated the mean and standard deviation. So the mean of this was 0.05. and expressed as a percent. So roughly 5/100ths, half of a tenth of a percent per day. And the standard deviation here was 1.2%. I also plotted the normal distribution here, the corresponding bell curve, as if it were on this plot here. The interesting thing about this is these actual data fall in a tighter range than one would expect for that normal distribution here. This distribution is narrower and peakier, so there's more tendency to be around this mean value than you would expect from that standard normal distribution, that standard bell curve. Likewise, there are more outlier moves here. You can't really see it well on this plot, but there's a whole bunch of days where the market was down almost 5%, a little more than 5%, 7 or 8%, and like one day where we kind of got to that 10% range. That might have been at the outset of COVID, because this data set kind of ends middle of 2020. But that's excuse me, that's historic. What about implied volatility? As I said at the outset in the intro here, implied volatility is the market's best guess of what that standard deviation of returns is going to be in a given options series and over a given span of time. But how is it calculated? Because obviously we don't know what's going to happen in the future. Well, if you look into option pricing models like the Black-Scholes model, there's only one thing in that model that we don't know, and this is that forward-looking volatility. We actually know the option prices. Those are those blinking numbers on our screen. So if we do, the calculation is a little more complicated than a bit of algebra, but that's the idea, right? You rearrange the equation to solve for that unknown volatility, and bingo, we have our number. And on shorter time spans, that number actually turns out to be pretty accurate. In fact, it actually tends to overstate the move. So generally, we have smaller moves than predicted by implied volatility. We also have more of those outlier moves, just like we saw here. We do have more of this, so it's not a free lunch. You just can't assume you're going to stay within one standard deviation or two standard deviations forever, more than you would expect from the statistics. And so you're going to have to know how to modify and defend options trades that go south, especially if you're trading naked options with undefined risk. Higher implied volatility leads to higher option prices. That's kind of self-evident. If you expect a stock to move a lot more, you're going to want to charge a lot more for that option, given that you're assuming you're going to have to deal with a lot of movement. If you know that a stock is not going to move, why charge? Out of the money option is not going to trade for much, because the probability of getting there is basically zero. So, more volatility, the higher probability of getting there, you're going to want to charge more for that option. The higher the implied volatility, the more the expectation of movement. That's just what we said previously. I prefer to trade because I'm selling options, selling premiums, selling naked options, selling credit spreads. I'm a net seller of options. So I prefer to trade in higher implied volatility environments, just because the option prices are higher, and it just makes sense to sell things that are expensive rather than sell things that are cheap. Hence high IV compared to low IV. So here we are in our trading platform, and most trading platforms nowadays will show you the one standard deviation and two standard deviation lines on your screen here. I'm in the November option cycle for 2025. I'm recording this on September 20th, 2025. There are 62 days till expiration here, and Tasty will actually give you the IV for this given option series here. So it's about 17.1%, and this number is expressed as an annualized number. So if you wanted to actually calculate what it is for 62 days, you'd have to do the math. But the platform will actually do it for you and draw out on the screen here these lines here. So this is your one standard deviation line to the downside. There's a corresponding one standard deviation line to the upside here. And also it will go to the two standard deviation line. So I can use this to choose my strike. So if I wanted to sell the one standard deviation put, I just look for this line, click that, I'm good to go. Notice that the probability here is about 16%. So remember that basically 68% are going to fall within one standard deviation plus or minus of the mean there of the current stock price. So if I were to sell the corresponding call here, I'm just rounding this down to 16 to keep the math nice. 16 times 2 is 32. 32 minus 100 is 68. There's our 68% of being within that range. Let's clear this out, and you'll notice that the 2 standard deviation is also about at that 5% range. So we have a 95% chance of being above that line at end of the November cycle. So that's it. Right now, in terms of trading and making money in high or low implied volatility environments, I find it difficult to put on a lot of trades or increase my contract size in low implied volatility environments because, as I said earlier, low implied volatility means low prices, and as a seller, I want to sell things that are expensive, not cheap. Plus, if volatility expands and I'm short something that was initially cheap and that price expands, I'm just losing money just because of the expansion of volatility. On the flip side, though, I want to, in a high vol environment, that's when I start selling more premium. And just for the opposite reason, I want to sell stuff that is expensive, and volatility tends to contract more than it expands. So once I've sold all that premium, there's a decent amount of chance that volatility will decrease, and I'll be able to make money both on time decay and on the volatility contraction. So that's it, guys. Any questions you have, please feel free to leave them in the comments, as well as suggestions for future videos. And until next time, see ya.